Hello and welcome once again to SB Talks. Today is Tuesday the 11th of April and I am joined for the first time in his formal capacity as Chief Investment Officer by Nick Ryder. Welcome, Nick.
Thanks, Vin. Yeah, hi.
And as part of a slight change to the format as Nick now takes over Chief Podcasting duties, is that we will be doing more regular but shorter form podcasts to keep you up to date for you all being busy on the move. So Nick, welcome, and we look forward to hearing lots more from you in the months ahead.
Great, thank you.
Now, Nick, when we introduced you to our clients on the podcast a couple of weeks ago, the main thing happening in the world was the collapse of Silicon Valley Bank and also the impending situation at Credit Suisse. A couple of weeks on now, the dust has somewhat settled. What more can you share about your views in terms of what happened there and also whether we should have concerns that there could be further dominoes to fall in that space?
Yeah, I think I might have said at the time, I viewed what went on with those particular US regional banks and Credit Suisse as being more specific issues with those organisations rather than being symbolic of a broader contagion or GFC 2.0, which is, I guess, what some people were fearing. I mean, I think if you dig below the surface, and a lot of this has been in the media, Silicon Valley Bank had a lot of what they call uninsured depositors, so people that had deposits over 250,000, and they moved en masse. So it's quite interesting in a day and age where social media can drive people to act all in one direction very quickly. We saw people getting onto their online banking and withdrawing $42 billion from Silicon Valley Bank in one day.
A very concentrated client base, in particularly a sector which is venture, which has helped them grow dramatically, but ultimately then led to the quick reversal.
That's right, and I think so that was very specific to Silicon Valley Bank. The other bank, Signature Bank, was caught up to some degree with what happened with Silicon Valley Bank, and there was a run on deposits as well, and the regulators stepped in realising that they wouldn't be able to meet those. So those two issues were largely specific to those banks, but I guess it has raised an issue more broadly about what's going on with the US banking regulation, where they have two tiers of banks.
There was a fear for the regionals may see a sort of an outflow, a tide of money head to the majors in flight for safety.
Yeah, and there is some evidence that is happening to some degree, although I think, the Fed stepping in and providing that funding facility so banks can borrow against their bond portfolios at par value is positive. There is a sort of a hint that uninsured depositors more broadly would be covered in another bank collapse. So I think that has also helped a little bit. But no, I think we are seeing some evidence that money is flowing out of the smaller banks to the bigger banks in the US and also into money market funds. Quite a lot of money has gone into money market funds, which obviously are probably quicker to pay market yields relative to banks, which tend to want to hold yields down.
So people are chasing a better rate of interest.
Basically. Yeah, absolutely. So I think, what does this mean more broadly? I guess the banks will probably hold more cash than they would need to cover this possibility that deposits will flow out. They'll obviously need to be more competitive with the interest rates that they offer on deposits. And their margins are likely to be squeezed. Things like deposit insurance are likely to go up, the cost of that. So I think it's a tougher outlook for regional banks and banks more broadly in the US. I think in Australia, it's a very different story. Our banks are unquestionably sound according to the RBA and the regulator. And I guess we don't have the same sorts of issues with two tiers of regulation that they have in
very
the US.
Concentrated banking system here compared to the US regional system.
Yeah.
And a few words on Credit Suisse there. Again, that was a very major transaction a couple of weekends ago.
Yeah, that was also an issue very specific to Credit Suisse. They've had a lot of missteps in recent years with some poor lending decisions to a large hedge fund and a whole series of scandals. And And I guess what prompted the run on Credit Suisse was I think it's the Saudi central bank said they wouldn't continue to put money in as an equity shareholder. And that was really because they'd reached their shareholding limit.
10% cap. Yeah.
But that freaked people out, and I guess in an environment where people were twitchy, it didn't help. So, like the US regional banks, they had a run on deposits, and credit spreads blew out on a lot of their securities. And the Swiss National Bank tried to step in and provide liquidity, but ultimately it wasn't enough, and so they had to force the merger with UBS and write off the contingent capital bonds, AT1 bonds, which has been caused a shock to many people that own these bank hybrids, that these things could actually lose money ahead of shareholders.
Well, technically that's their job.
Yeah, they're loss absorbing, yeah.
So, against that backdrop, despite that, March actually was quite a positive month for equities, and you touched on financials, not necessarily the case there, but more broadly.
Yeah, so, US bank shares were down about 20%. Australia, our banks were only off for a few percent, so they held up a lot better. But, despite that, the US equity market and global equity markets were up. And it was a case of what I said in my note, bad news is good news. So bad news about the possibility of slower economic growth, slower bank lending, has caused bond markets to pull out a lot of the rate rises that had been priced in, and now price in cuts from the Fed and the RBA. So
let's just take that a step back. So it's a very similar scenario that we had sort of 10 years ago as we emerged from the GFC, where the bad news story was typically the best night on markets. We've seen, really, given this is creating potential additional challenges for the economies, that maybe the central banks aren't going to have to go as far and may be able to start cutting sooner. What are some of the expectations there?
Yeah, so for the RBA, no more rate hikes at all this year.
So last week we saw they basically sat on their
paused,
hands. Yeah.
And the market's saying they're done this rate cycle, and that there'll be rate cuts, small rate cuts by year end. So I think there's about 15 basis points of cuts priced in by the end of the year.
Right.
So not a lot, but maybe one cut. And then for the Fed, there's a 70% chance that they'll hike again by 25 basis points in May, and then they're done. You know, and then there's rate cuts similarly priced in by year end, about 44 basis points.
The Fed being quite a bit ahead of the RBA in terms of where they're at on their rate increases.
Yeah, so that's the case. Yeah, where bad news is good news for bonds and for equities, because it's reduced the rate rise expectations and lowered bond yields quite significantly, and that's helped equities, particularly growth equities, which are sensitive to rates.
Yeah, so a feeling that we could be closer to the top of this rate cycle, potentially.
Well, it's actually not my view.
Right.
I actually think the market's gone too far the other
overreacting
way.
to the events.
Yeah, I think, yes, there will be some slowing of lending, particularly in the US, but I don't know it will be enough to really have a meaningful impact on inflation, which still is the big story.
Well, let's talk inflation then. So it still remains fairly stubborn.
Yeah, I mean, the headline inflation has been coming down. So I think about inflation as having three parts. There was the sort of the COVID-driven supply chain issues, and they're largely all now cured. So if you look at sort of supply delivery times and price of shipping containers and all those sorts of things that were symptomatic of the COVID supply issues, they've all resolved themselves. So that part of the inflation story is over. The second part was the war in Ukraine, and that really impacted oil and food prices, and that to some extent is largely reversed as well.
It first started happening now over 12 months ago.
Well, that's right. Yeah. And we also get the base effects where we're looking at inflation today compared to the same time a year ago, and so we'll start to see some of those issues roll out of the numbers, the yearly numbers. So oil prices are well off their highs. But the third part of the inflation story is the more problematic part, which is basically driven by labour markets, and we've got strong employment still in the United States. So last weekend we had another non-farm payrolls number, was still pretty good. Unemployment 3.5% down from 3.6%. Average hourly earnings, they're still reasonably elevated, about 4.2%, which is probably above where the Fed would be comfortable with them. So yeah, it's still that part of the picture is what's creating a lot of strength in the services sector. So inflation in the services sector, and particularly in rents and things like that. So people obviously are in work. They can see there's plenty of jobs around. They're getting pay rises, and they're going out to restaurants and travelling and things like that and spending it.
So the Fed, given its priority of trying to get inflation under control, you're saying they still probably have some work to do?
Yeah, well, they know they need to lift the unemployment rate. 3.5% is too tight. There's for every unemployed person, there's 1.7 job vacancies. So the labour market's still too tight, and that will create this ongoing inflation in wages and in services-driven inflation, which is linked to wages. Excuse me.
And Australia?
Similar story, we have 50-year lows in the unemployment rate, about 3.5% as well. We don't have the same wage pressures that they have in the US, largely because our system of wage setting is more glacial in the way it moves, with enterprise bargaining agreements and award wage negotiations and things like that. But we could, people are making noises about, potentially larger wage rises this year. So,
and if they creep their way into the system, then it becomes a bigger job to try and
that's
keep
right.
a cap on the inflation.
That's what they call the wage price spiral, and that's what central banks are trying to stop. So it becomes self-reinforcing.
So do you foresee that we get potentially a bit more upside on the rates?
Yeah, I think. At the start of March, the markets were pricing in 3 more rate rises from the RBA to about 4.4%. And now they're pricing rate cuts. So I think, as I said, Australia doesn't have a banking issue problem that the US does. So our banks, what has really changed in Australia? Not that much. Okay, we did get a February monthly CPI print that was a bit lower, 6.8, down from 7.6 for the quarterly number.
But
7.8.
Yeah, but still a pretty solid number.
It's still way too high. So RBA's still got more work to do, I fear.
And let's talk about just one other specific asset class, just when we're doing a bit of a round there. And while equities broadly were positive in the month of March, talk about the listed property space and what we've seen offshore there.
Yeah, so listed property had a poor month, and I think there's a couple of things driving that. The first is, and I'm talking about global listed property, obviously the US is a big part of that, and the regional banks are large lenders to commercial real estate in the US. Yeah. So they lend to, property, a lot of properties, small businesses that use that money to buy property, or office buildings and things like that. So obviously people look at that and say, okay, well, credit's really going to be tightened to that sector, and the lifeblood of the property sector is bank finance. We know that more broadly. So that's part of the story. I think the other thing that's going on is there was a couple of high-profile institutional office owners that essentially handed back the keys in the US. And the reason is, people still working from home. Office occupancy is probably about 50% of where it was pre-COVID. Companies are handing back lease space, and so in some cases, the interest bill, because it's floating rate, most of those loans, it exceeds the amount of rent that's being collected. So we're starting to see the cracks appear in particularly office property, and also in Europe as well. Yeah,
and I guess this is sort of a natural flow through from the effects of COVID and a change to work from home dynamics. Now, we're contrasting listed property markets versus unlisted property markets, because unlisted property markets are really dependent on a transaction or a revaluation to see, I guess, the valuation reflect what's happening in the market.
Yeah, well, there just hasn't been a lot of transactions, and I think that's one of the reasons why the unlisted office market is still sort of seemingly holding up. But it faces the same dynamics.
Exact same demand-supply dynamic,
yeah.
Yes.
So to the extent that, the unlisted market, that, tenants hand back space because it's not being used, or try and sublet it, then there's going to be downward pressure on rents, and that will eventually start to flow through to the unlisted valuations as well.
So fair to say, given what's happened to listed property valuations at this time versus where sort of unlisted ones are holding up, you'd be relatively cautious about applying new capital to unlisted property.
Yeah, particularly office space. I think, other sectors like industrial still look pretty good, although expensive. So I think it comes down to which sector you're talking about. But certainly I wouldn't be chasing office property,
this
particularly in the unlisted
cycle.
space, no.
And looking at more broadly, what's your views of the world given what's happened on bond markets in particular in terms of portfolio construction?
Yeah, well, as I mentioned to you, I think the bond market's overreacted to these banking issues, and once the dust settles, we might see the Fed and the RBA back on the hiking trajectory, and that will pressure bonds. So I'd be still underweight duration or bonds. And in terms of equities, I think it's, equity markets haven't really reflected in a slowing of economic growth or the really the weak underlying earnings picture. So we get first quarter US earnings start this week, and it's expected to be pretty dismal. 7% drop in earnings compared to the same quarter last year. So earnings aren't growing. Companies' profit margins are being squeezed.
So the big expectation was that the market hadn't yet priced in declining earnings into valuations.
No, it's looking through this sort of short-term issues. But even looking out to next year, earnings are looking pretty flat. So I think it's hard to get too excited about equities in an environment where earnings aren't growing and bond yields potentially rise, which would pressure valuation multiples. So I don't expect this to be a great year for equities, but then I'm not also that bearish on equities. I think, people are very comfortable buying the dip, and we've seen that repeatedly over the last 6 to 12 months.
And a focus on quality above all else.
Yeah. But I think sort of on a relative basis, bonds actually look more attractive.
Given where interest rates are now.
Given where interest rates now are. And a lot of the driver of equities, post-GFC has been, the TINA principle. There is no alternative. You're getting no income from cash and bonds, so you had to be in equities. Well, that's kind of reversed.
That's not the case anymore, certainly. And last question, as you sit here formally now in the Chief Investment Officer role, what can we expect from you over the months ahead in terms of as you take the reins and you pick up the ownership of the portfolios?
Yeah, so my first priority really is to look at the portfolios from a portfolio construction and asset allocation perspective, very much, how are we going to build these portfolios to deal with some of the challenges we've discussed today, but also, potentially longer term theme of inflation being maybe more of a thing going forward than it has been. So we want portfolios that can beat inflation. So does that mean we need, potentially a different mix of assets for the period ahead? So that's my priority over the next few months, is to really look at the asset allocation, the weightings to different asset classes that we have, and say, okay, is this the best portfolio for what we see as being the next?
That's the environment that we're in right now.
Yeah.
A big question, and for listeners, you'll be able to hear from Nick. We actually have an event on the 20th of April as well, so we'll share out some details of that with you. But for now, thank you very much. Welcome again.
Thank you.
And thank you to all our listeners. Have a good day.
Thanks. Have a good day.